Hey, good morning, everybody. Welcome to another day of Market Report brought to you by Mike Bjork. Today is Monday, March 16th. Hey, I hope you guys enjoyed a great one. It's been hot here in the SoCal, about in the mid 80s here at the beach. Also been a little tied up with my son. Get this, he had a he had to create a leprechaun trap for tomorrow, so we had to have that due today. So kind of cute, something different. Hadn't done that, and I guess he's under belief that leprechauns are for real. So, anyways, it was kind of a fun weekend. Anyways, get right to it. We got a few economic news releases scheduled for today. We'll start off with the Empire State Index. Back in February, we had a 7.8 reading, and forecast was supposed to go up, and it actually came down to 6.9. Now, the Empire State Index is basically the manufacturing numbers out of the New York region. So, obviously, we see a pullback when there's expectation of the fact in the manufacturing section in the New York region. So obviously not a good start for the day. We got the industrial production. This is kind of the output for all the different industries and factories and manufacturing. And we had it actually revised from January from zero point 0.2 up a plus, actually down to negative 0.3%. So the forecast was supposed to go up to 0.3% and it only came up to 0.1%. So again, not so good of numbers right there. And it kind of corresponds to what we're seeing out in New York. Capacity utilization. We're at 79.1. Back in January, we were again supposed to expect increase in February, and it actually pulled back. So even our capacity isn't that great. So we're not using as much as we could be using. Pulled back. And then we got the home builders index. This is the confidence level for the home builders out there, and that even decreased. As you can see, back in February it was at 55. It was supposed to increase to 57 was expectations, actually pulled down to 53. So basically anything above in these scenarios when you see this 50 is anything at 50 or plus, it's an expansion. Anything below that, it actually decreases. So we got the headline news here. The stock market's currently up. It's kind of after last week took a bit of a beating. It's kind of in a purchasing mode, but also what's kind of stimulating it is stuff out of Europe and Asia. With the kind of easing in Europe with the ECB, they're creating a lot more liquidity in the central banks in Europe. And then, of course, today the president of China had promised some sort of stimulus package to be coming up sometime in the future. So this is kind of getting a little bit more optimistic out there. Bond market, we're actually up about 5 basis points from where we left off on Friday, so that's a good news, which translates to a slightly better pricing in our interest rates today. So obviously good news in that regards because we all like to see better interest rates in the meantime and lower our payments in the process. All right, folks. Hey, we're going to call it a day today, and we will catch you guys tomorrow. Now, one of the big things this week will be the FOMC meeting. They're going to do their 2-day meeting starting tomorrow, and they'll give their final announcement on Wednesday. So expect a lot of volatility in between there. Now, one of the things to prepare for is Janet Yellen had kind of prepared the investors and people out there to don't get panic when if you see them take out the wording patient by the Fed, because it doesn't mean that they're going to raise rates right away. So we're kind of the only country in the world basically that's basically doing well enough that we might actually be tightening up policy versus everybody else trying to do some type of stimulus to try to create some type of spark in their economy. And this kind of has investors a little bit worried. But anytime we go through transition, there's that, especially when there's free money being passed around, it's kind of like crack, people use crack, they get so used to it that as soon as they go through the withdrawals, this is what this transition is going to be kind of similar. We're going to go a little painful period there probably have a little bit of that's probably when we'll have our correction in terms for the stock market, which has been way overdue as a result. So they'll probably pull back a bit before they go upwards again. All right, folks, so be prepared for that. That could be translate good news for bonds and interest rates in the housing market, because that money that comes out of the stock market typically goes into the bonds and helps out the interest rates. All right, you guys have a wonderful day. Thanks so much for your time, and we'll catch you guys tomorrow.